Yeah. So, Mike, I think just to clarify this for folks, I think this is financial life support for banks that are in trouble. The Fed's role is, for better or worse, is a lender of last resort. And if you look back at the chart that you put up there, you see that basically the Fed steps in with excessive repo support, when the system gets into trouble. So you can see in the last recession back in '08, it spikes and then it comes down, and then it basically goes away before we exit the recession, because by that point, a lot of the challenges that we were dealing with were beginning to resolve. Then, of course, at the end of 2019, it explodes out of nowhere, which is a signal that somebody was in really big trouble. Somebody was being kept alive by being given huge loans day after day after day, or as you said, Mike, they began to extend them by like a week loan or a several week loan or whatnot. But make no mistake, that's life support, keeping a big player or multiple big players alive who would otherwise die, essentially without that free money. I just want to share that we saw this back in 2008. This report by the Martins says, back in 2008, Citigroup was insolvent for much of the time the Fed was flooding it with cheap loans. I think that's what was going on here. You had banks that were in danger of becoming insolvent. And just looking at this chart, Mike, that we sort of reacted to, and in the first place when we saw this report, Nomura, JP Morgan, Goldman Sachs, et cetera, received a cumulative total of $8 trillion from this repo program. And you're seeing like Deutsche Bank got over $1 trillion. Barclays got $1.5 trillion. Same with Goldman. Nomura got almost $4 trillion. So I think there was something going on in the banking system where these major banks were all of a sudden in danger of getting caught with their pants down and maybe having a Lehman type moment. And the Fed came in and just kept them alive with this life support for long enough for the problem to get contained. And maybe that's the right thing to do for the Fed, maybe it's not. But the fact that we weren't told about it and how close apparently we came to some major systemic breakdown, I think is really concerning. The thing that this shows, we did come very close in 2019 to the entire financial freezing up globally, the entire financial system freezing up globally. And who knows what would have happened. But this was the first chart, it shows Nomura, JP Morgan, Deutsche Bank, Citigroup as being the big ones, and Goldman Sachs not really taking that much. But when you do what Pam and Russ did as far as multiplying this out, basically it's taking the amount times the term of the loan. You see that Goldman Sachs had to have capital for they had the capital for the longest period of time. Between those banks, they took the least initially, but they held it for a very long time. And that's what this multiplication does. So it really does point out who was in the deepest doo-doo. And it was Goldman Sachs, JP Morgan, and Nomura. But right. It also may be instructive, too, in terms of why the stimulus that was flooded into the system the next year in 2020 was as gargantuan as it was. It might have been using the pandemic as a bit of a smokescreen to be able to feed a lot more support into these institutions to make sure that they, remained alive through it all.
Yeah, it also shows that one of the things the Fed had said that this was due to tax season and end of the year, and these banks needed currency. But the thing is that Nomura, Barclays, and Deutsche Banks are trading affiliates of foreign banks. And so Pam and Russ say, are we really expected to believe that the U.S. corporations are holding their quarterly tax payments with the trading units of foreign banks? Because these foreign banks needed the bailout. And so this smokescreen, basically lie that the Federal Reserve came up with to try and calm the public down. Oh, it's just because they owed taxes. No, there was a real serious meltdown going on here. And, in closing, they say that the Senate Banking Committee and the House Financial Services Committee, it's time for them to haul the relevant parties into a hearing and get to the bottom of this. What was this, and why is this stuff happening? what it shows is, if this is happening, it shows that the banks are not stable, that they are taking on far more risk than they should be taking on, that these fiduciaries, trusted financial institutions that have a responsibility, are being they're pushing things to the edge because of competitiveness. They have to try and out profit each other, and that competitiveness leads them to walking this razor's edge of global financial meltdown, maximum profits.
Yeah, we talked a little bit about this last time I was on, Mike, and thank goodness for real gumshoe investigative journalism like the kind being done here by Pam and Russ Martins. Back in 2019, we knew something was going on under the sheets there. I mean, we knew that the numbers that were flooding into the repo market every night, were gargantuan, like nothing we had ever seen before. But we weren't being told anything, and it was being put off as like, everything's fine. Well, now we're actually beginning to get a sense for the order of magnitude of the trouble that a lot of the country's biggest banks were in. So, Mike, looking at the charts here, like how much is the cumulative total that these banks received during that period?
Well, it's pretty gigantic. But before we get to that, I just want to show everybody a chart of the repurchase agreements. This is the Wednesday level. So the middle of each week, the Fed reports the Wednesday level. And normally this is intrabank lending. So everybody needs to understand what repos are. And a repurchase agreement is one bank needs some cash. They need to borrow. They put up a bond and they agree to repurchase that bond, usually in 24 hours, the next day. You see them going along here, and then the Fed just completely stepped out of the repo market, and the repo market was all basically the free market controlling it, the banks determining what the rates were and stuff, and then suddenly the Fed jumping back in. So you can see the scale of it from the Federal Reserve reporting. But Pam and Russ Martins, they're talking about normally these loans are one-day repo loans. But very, very often they're rolled over day after day after day. So basically it's a 24-hour loan that gets paid off 24 hours from then by financing it with another loan for 24 hours. And so during this period of time, the Fed added 14-day, 28-day, and 42-day loans. So if their example here is, let's say a trading firm took a $10 billion loan for one day, but that same day took another $10 billion for 14 days. The 14-day loan for $10 billion represents the equivalent of 14 days of borrowing $10 billion, or a cumulative total of 140. I'm not sure that this is, I'm not sure whether, I mean, maybe this is correct way to look at it. Maybe it's not the correct way to look at it. There's 10 billion outstanding at all times on this loan, because it's getting paid off. If it's the equivalent of 14 days of borrowing $10 billion of those 24-hour loans, if there was 14 days of borrowing those loans, they get rolled over day after day after day. And so it isn't 140 billion. Nevertheless, there's different ways of looking at this accounting wise. It is shocking. Even without the multiplication of looking at it, using this other method of cumulative total of, if they took this $10 billion loan that was for an extended period of time, how does it compare to a 24-hour loan for the same amount? Is it cumulative or not? Without that multiplication, it still totaled $4.5 trillion, which is an enormous amount. This is a huge fraction of the U.S. currency supply. The Fed, remember, the Fed invents this currency when they make the loans, and then the currency gets extinguished when the loans are repaid. Now, if you do this multiplication by accounting for the number of days that the loan is outstanding, then you're talking about just under $20 trillion.